Hello, and welcome to Nutmeg's Investor Update for November. I'm Kira Stacey, People Manager in the People and Talent team here at Nutmeg. I'm joined by Shaun Port, our Chief Investment Officer. Hi, Shaun.
Hi, Kira.
Shaun, October was a very difficult month in the markets. To a novice investor like myself, there seemed to be a lot of noise in the press about big market falls and corrections. My own Nutmeg pension showed a big loss. What happened in the markets?
Well, let's start with how bad was October. Well, it was pretty bad. So global stock markets fell by almost 8% during the month. If you look back at the record of global stock markets since 1970, it ranks as the 22nd worst month, so in the worst 4% of months. And out of the 46 markets that we look at, only Brazil managed to produce a positive return. Now, beneath the surface, there were some pretty big losses in individual company shares. So if we look at Amazon, for instance, the share price fell by over 20% during the month. So within the market, there was a lot of turbulence, a very big fall in global stock markets. And actually, if you look at other assets as well, like bonds, they didn't really manage to produce a really significant positive return. So overall, it was a really difficult month for financial markets.
So what was the cause of this big decline?
Well, I mean, in days like this, when markets are really volatile, we saw the US have 2 days during the month when prices fell by 3%, so really big moves. Often you'll see investors and press and analysts really try and attach a story to what happened to sort of rationalise why markets have fallen by so much, and there's a few stories floating around. For us, what we've looked at is really the hard data, to look at the data and say, actually, what do we think caused this decline? And we've also looked at a lot of research coming out of the major investment banks, particularly from the US, to see what are their opinions. And all this really points to is a more of a technical move around sentiment, and particularly around short-term investors like hedge funds seem to have de-risked, potentially sold a lot of holdings in technology stocks in the US, which has been where a lot of the price gains have been seen this year in the US. And it's more about sentiment changing rather than any sort of shift in the fundamental picture. And the fundamental picture is really important for us. You know, as long-term investors, we're thinking about what's going to happen in the next 1, 2, 3, 4, even 5 years ahead. Where are the returns going to come from? And we actually haven't seen a deterioration in the fundamental picture. The global economy is doing pretty well. Companies are reporting really strong earnings. So 77% of US companies have reported better than expected earnings in this current reporting season. So the fundamentals look really good. So it all looks like a big shift in sentiment rather than any fundamental deterioration in the outlook for global markets.
So that's the global picture. What about UK markets?
Well, the UK markets are never really immune from what happens in the US and global markets in general, but the UK equity market tends to be more defensive. So when global markets fall, often you see the UK equity market fall by less, and that was the case in October. So the UK equity market fell by about 5.5% during the month. It's still down by about 8.5% so far this year, but it fell by less than you would have seen global markets fall. Often it's helped by a weaker pound as well, and that was the case last month. The pound fell by 2%, and that generally tends to help UK equity prices. If we look at government bonds, they produced a return of about 1%, and company bonds produced a return of about 0.5%. So generally a similar picture compared to global markets, but slightly better from UK equities.
And how are our fixed allocation portfolios performing?
Well, given the big fall in stock markets, Kira, it's not surprisingly we saw quite large losses in our fixed allocation portfolios during October. So our lowest risk portfolios lost around 2%, our medium risk portfolios lost around 3.5%, and our highest risk portfolios lost around 6.5%.
So have the investment team made any changes to the fully managed portfolios?
We've made some small changes to portfolios. We've reduced our holdings of UK equities and core Eurozone equities in favour of Japan and Nordic countries. That's really about better growth prospects from those markets rather than reacting to the volatility of markets. I think there's a key question here, actually. Should you react when you see a big decline in prices? So, for example, should you start de-risking portfolios? I think for us that's a really fundamental question. If your outlook for the global economy and for company earnings hasn't really changed, should you react? Well, actually, when we look back over the past 30 years and look at high periods of volatility when markets are really unsettled, actually the returns over the next 12 months overwhelmingly are positive unless you see a recession around the corner. And absolutely, we don't see a recession around the corner. So we're sticking really to our core fundamental view that the outlook's still quite good for global equity markets, despite this really short-term volatility we've seen.
Thanks, Shaun. And whether it was via our social media channels or our customer support team, we heard from our customers during October with concerns about market performance in their portfolios. So this month, instead of a customer question, we know you wanted to tackle some themes.
Yes, that's right, Kira. So I've made sure I've read every single comment that's come in from customers, whether it's through our customer support team or whether it's through social or other channels. And there's some interesting themes there that I want to tackle, and actually in particular 2 points. So first off, often customers comment that gains come quite slowly and steadily, but losses come quite quickly, more in a matter of weeks rather than months. And there's a good reason for that, and it's completely explainable. So if you look at the long-term performance of financial markets, a lot of your returns come from income, like stock dividends. And we know the dividend yield from global stock markets is about 3%. In the UK, it's about 4%. So there's a steady income flow coming from owning stock markets, from owning stocks. And similarly, you get an income from bonds as well, which is quite regular. So gains come a lot from income, but we know that prices, particularly for equities, are quite volatile. And that really explains this sort of mismatch, that you get gains quite slowly as equities climb this sort of wall of worry and you're getting income, but then prices can adjust when sentiment shifts. So that's really quite explainable and actually quite normal. But it's an important point to say is actually that these losses aren't really losses on falls in stock markets unless you sell. And we know that stock markets can actually snap back quite quickly and somewhat quite unexpectedly. When you see a lot of bad news, stock markets can continue to bounce back quite strongly because they're looking much further ahead than the current kind of noise or news that you're seeing now. Secondly, another key question is what changes are you making to make back the gains? Now, in times like this, when markets are volatile, it can feel really comforting to make changes because you think, I'm making changes, it's going to be better because of these changes. And actually what we know from experience and looking at the data is that when you try and time the market, when you think about taking money off out of stock markets and putting it back in when stock markets are calmer, often that leads to much larger losses. So it's actually quite counterproductive, and we've run lots of data on that, and we see overwhelmingly when you try and time the market, you'll get greater losses than if you stayed invested because markets bounce back quite quickly and quite unexpectedly. Even when things look quite bad, markets can react and turn quite positive quite quickly. So it's important not to try and time the market. So for us, we're sticking to our investment process. We're looking at what's happening in the next few years. What is the global economy going to look like in 2020? What are companies saying about their prospects for the next 3 years? What's coming through from cost pressure on margins, or what's happening to interest rates? We're sticking to fundamental factors and not really being distracted by this short-term volatility in markets.
Thanks, Shaun.
Thanks, Kira.
And thank you for joining us. If you'd like your investment questions answered by our investment team, please feel free to contact us via email, social media, or in the comment section below. We look forward to seeing you next month.